Alright, it looks like we are up and running. My dog will run around over here. Good evening, everybody. I'm just going to give it a minute. Hey, hello. I'm glad you could join. This is going to be a good one. You're going to help me. Let me know how the volume is. Could you hear me? Is it too loud? Is it too low? I want to get this over with before I get into the webinar. Volume's low. What about now? Is that better? What about that? Is that any better? There we go. Try to keep it around there. Yes, better? Okay, awesome. Alright, good evening. I do just want to, again, just give it another minute just to let some people join in. Last week we got a bunch of people joining. Alright, and again, tonight's webinar is going to be on support and resistance. Last week we did supply and demand. Tonight we're going to do support and resistance. What's great about support and resistance and supply and demand is if you know both tools, you could then use them together to get more accurate entries, exits, targets, and to really manage your stop loss. I'm just going to give it another couple minutes, guys, because again, we did have a pretty good outcome last weekend, so we're just going to let it roll up a little bit. And again, guys, volume's okay. Everything's coming through all right. I don't sound low. I don't sound like an echo. Everything's okay. Hello, hey, what's going on, Aaron? Awesome. Looks like everybody's joining. Great, fantastic. Welcome. No echo? Awesome. Very good. Alright, so I guess I'll get into it. So tonight's webinar is going to be based off of support and resistance, how I find support and resistance, what is support and resistance, and I'm not going to go too much into how we use support and resistance with supply and demand, but I will talk about how you could use them together. Alright, so support. So when we talk about support and resistance, what are they? What are we talking about? Support is a price level where demand exceeds supply, acting as a floor which holds price. Think of it like it's supporting price up. So it's supporting it, it's holding it up. Whereas resistance is a price level where supply is exceeding demand, acting as a ceiling, preventing the price from moving higher. So think of it like it's resisting this level. It can't go any higher. That's the ceiling, supports the floor. So this would also help give you a range as well. So understanding support and resistance helps us traders because it helps us make better decisions on our entries and exits, where we place our stop losses, and where we place our price targets. Because all depending on what price is doing and what the market's doing, we could be rejecting and we might want to short it, or we could be holding and price could be supporting and we might want to go long. Because again, support and resistance, that's normally the range of the market. Right, let's see. So, another thing we do often see is support becomes resistance, resistance becomes support. And the reason for that, for support becoming resistance, is when we see support level is breached and the price moves below it, it signifies a shift in market sentiment. The level was previously acting support, now it's broken, now it's going to form some type of area of resistance. Hey, what's going on, Tom? Welcome. Think of it like traders who missed the initial break of structure, the traders that missed the supply break to short it, they're going to be watching that area to short it again. So support, it was support, now it's acting as resistance. It's all psychological. Everything, a lot in trading has to do with psychology. So let's see, let's get into how to chart support and resistance. We'll get right into it with ES, that's the futures of SPY, the S&P 500. And what I always do, just like spotting supply and demand, is you want to look for the higher time frame first. The higher the time frame, the stronger the zone. So you could also do this with different colored trend lines, and you could say, okay, well, I know the gold is stronger than the blue because blue's on the smaller time frame. And once you have support and resistance levels, you're able to add supply and demand to your levels and to your zones and really get better areas of interest, better areas where you could go long in the market, short the market, and target. And it really makes the market less of a what's going on, makes it more of a, oh, I see, that's why it happened. Remember, when we're trading in the market, we don't want to be gambling. We want to be taking more probable trades. So if I'm looking at the higher time frame here, I'm going to mark something up here. I'm going to mark something right here. But right now what I'm going to do is I'm going to look for something where we sort of stalled out, and that's going to be a support. That's going to be a resistance. Right here was resistance, then we broke it, came up again. This was an area where we consolidated as well. And then again, here we go, we're resisting it. Every time we broke it, we rejected. Every time we came under it, we came back up. Every time it's a liquidity grab. So sometimes, a lot of times with these key levels, and when I say key levels, I'm talking about support and resistance, we have liquidity grabs. We have breakup structure momentarily and a quick move right back. And what that's doing is that's tricking retail, that's trading people who are watching this level, that were either stopping out at this level or going long once we break this level. They're now in their long positions just to get stopped out, and that's what fuels us to a lower move. We don't want to be that liquidity. We want to play the levels smart. We want to play them strong. Is it like supply and demand? The more they touch, the less strong they become? No. So, Tom, that's a great question. With support and resistance, it's almost the opposite. The more touches and the more times you get consolidation and a rejection off of the support and resistance level, the stronger it is. So like right here would be a strong area because it sort of double bottomed here at some point. And again, it's always good to look left. Gotta look left because again, the more touches, the better. The more history this level has, the better. Look left will do right here. And I mean, if we marked these lows just from way 2021, we would have had these key levels that held over here in 2022. We would have had these key levels that held. And that's what's really great about support and resistance, along with supply and demand. We might not have had any supply or valid supply or demand down here, but because we had key levels, we knew, okay, if I'm shorting below here, this key level 38.55, I know my target's going to be the next key level, and vice versa. If I'm going long off this key level, my target's going to be this next key level. And that's what's great about support and resistance, is like supply and demand, it sort of gives you the range. Sorry, I'm keep looking over here. This was where the camera was. Camera's over here now. So the more, and you also have to consider the fact that when you are trading and plotting supply and demand and support and resistance, whatever you could do on the larger time frame, you could also do on the smaller time frame. So if this was the 5 minute, you could mark it the same. Are those areas going to be as strong? Absolutely not. That's why I always like to stick with the larger time frames. So we see this was a super strong area. Why? Because we had rejections, then we held it. So it was resisting, it was supporting, it was resisting, supporting, resisting, support, resistance. And that's what's great about these levels, is they prove to play out often and throughout history. And just like they say in school, they say history repeats itself. There's volume and volatility, and there's volume, historic volume at these levels, and that also makes them key psychological levels as well. And I also wanted to get into how psychology plays a big part into trading and finding these key levels. So a lot of times we'll see a whole level be a rejection. Let's see, right over here, look at that. I marked this key level right from over there to the left, and that just so happens to be where we wicked off of this past Friday. That was a nice key level. You see how these play out? Now, they don't always play out to a T. Intraday they can. Sometimes they do. It's all about market context. Let's take a look at the 5 minutes, see how that played out. Yeah, look at that. We got a nice rejection. We had a wick there, and these bottom wicks would have signified that buyers were stepping in and no longer letting sellers hold, and it was reversing, and we held. And if you entered here, you would be able to place your stop at the key level, and you would be able to target. See, at this point, because of, again, of the lack of supply and demand we have at these levels, because now these are new year-to-date highs, you would have to go back and look for some more key levels to target. Or again, you could look for key psychological levels. So 4360, when I say key psychological levels, I'm talking about whole number levels. So 4360, 4370, 4375, whole 70s, 75s, 5s, 0s, 10s, hundreds. Those are key psychological levels. Like 1300, no, I'm sorry, 13,000 on NQ was a key psychological level that we held. Right over here, our highs were, let's see what the high of this candle was, 4369.50. So it was close to the key psychological level of 4370, but it was 2 ticks away. So let's look back and see if we could find another good zone or a key level that we rejected up here. So look at that right here. Let's see if that's gonna line up with it. I don't think so. Nope, that's a little high. Now again, guys, it's not always gonna line up, but what we do then is we create new key levels. We can make this an intraday level where we rejected. The market's always gonna give clues, always gonna give context, and there's always new volume coming into the market. I see that you're using a 6-hour time frame. 6-hour may not be a stronger level for equities. Yeah, so yeah, the 6-hour definitely. I wouldn't recommend using the 6-hour on equities. I would probably suggest doing it on just futures, just because futures are open 23 hours a day. I'm sorry about the dog. Futures are open 23 hours a day, so there's more liquidity. That's why I'm doing the 6-hour. I would normally do like a 4-hour chart is good as well, but yeah, I'm just on the 6-hour just to give you guys examples. If you want, I could go on another smaller time frame as well. Use wicks or bodies, does it make a difference? So Thomas, that's going to depend on the time frame as well. I just want to take a look. Let's take a real quick look. We'll do the 4-hour. Oh, what I was doing intraday was I was going to look at the 15 and see if we have any type of high or low situation, which we do. We had this high or low right here, which signified a shift in structure. So if you wanted to do a supply or demand zone, you could do a supply zone potentially right up here. But let's see if we have a higher time frame zone. I believe we had a 1-hour, right? So we had the 1-hour basing. I called this out Fridays live if you guys want to check that out. This would be a valid supply zone, except for the fact that it didn't have follow through afterwards. But you would look for some type of basing and a big drop candle right after, just like this one. But that's supply demand. I want to stick to support and resistance on this one. So to draw key levels, and again, guys, when I mention key levels, a key level is support or resistance, and support does become resistance, resistance becomes support once we do breach those levels. So let's look back, and this is why I don't really like using the 1-hour, because you could end up with a lot of levels. Although it could be valid, I personally don't like going lower than a 2-hour. I would maybe do a 1-hour. So sorry about that. So it's gonna pick up. So yeah, when you go over to the 2-hour, you're gonna get a lot more levels, but that's also gonna give you a lot of good ranges. So you could find a key level right here, because look, we had 3 touches right here, and then we broke, we went higher, we sort of stayed in this range. Each time we broke below, we rejected and came back higher. Each time we broke this high, we rejected and came lower. If anything you wanted, you could move this key level higher to about here. Right, so key levels could always be moved around. You got to remember, when you're trading and using key levels in your trading style, they're not always going to be perfect. They're not always going to wick off of exactly. There will be times where we breach and bounce. Just because these are key levels, these are, almost think of them as areas of interest, because where you might have a key level, somebody might have a key level 3 points away, 4 points away. So it's a key level / area of interest. And what I do sometimes, if I have 2 key levels that are close to each other, for example, if I did have these right here, then I would maybe do a area of interest. And what I would do for that is I would do a rectangle, and I would plot it from here to here, and I would make it blue, and I would just remember, okay, this is going to be my area of interest. An area of interest is like a supply and demand, where when we come into it, we tend to reject back to the other direction. So we come into this area of interest, we reject and go higher. We come into another area of interest, we might reject and go lower. Here's the yappy dog. Again, I do apologize about all that. So let's look into another higher time frame situation. If you guys do want, we could look into an equity. Let's pull up. What's a good one, guys? I feel like a lot of equities are making year-to-date highs, so it's sort of hard to find key levels on them. Microsoft, right? Let's see, maybe. Okay, here we go. It's some good examples on Microsoft. So we can mark a strong key level right here. And what we could look for as well is, see how we had this big range right here? We would mark somewhere near the bottom of this. And what that's going to do is give us this range. And you see we broke it, we came back, we reclaimed this zone to grab liquidity before pushing lower again. Remember, the market needs to pull back and grab liquidity before it's able to make another leg down, or before it's able to make its initial push. The market can't move without liquidity. Liquidity is volume, and volume moves the market. Let's see, we could spot another key level right down here. Right there. So you see it even rejected right over here. What does grab liquidity mean? So Tom, when I mention grabbing liquidity, I'm referring to breaking of structure, or breaking a key level and then quickly rejecting. So what that's doing is, when I mention grab liquidity, is it's faking out a lot of sellers. It's faking out a lot of buyers. Whichever direction it's faking, it's grabbing liquidity. So right here we're shorting, right? Somebody's shorting Microsoft under 280, and they go lower, they short it. Now we sweep up higher. They were the liquidity that just got grabbed. Now we're going higher. They got short at 280. Microsoft's back to 310. They're probably filling their short. They're probably exiting their short order, which means they have to buy back. And what that's doing again is fueling the liquidity and fueling the move higher. So a lot of times we'll see a break of structure, a retest, and then a move lower again, because this first break of structure, now people see we break below this key level. Everybody was watching this 317, 318 key level on Microsoft. Now we're below 318. Everybody's shorting it. And before it gets to, right, it gets under 305 for a moment, comes back, and now the people who shorted it at this key level are most likely stopping out, because it was a bull or a bear trap. So this right here was a bear trap at first, because it did go lower, but we pulled back. And this pullback right here was again a bullish. This is now the bull trap, because now people are saying, oh, well, we're back in the trend, we're back in the channel, we're going back higher. And they're getting long at this level. Meanwhile, this was just a pullback before the real move lower. The people who got in short and maybe scalped $10, $15, about $10 on Microsoft, that's a good play. But the people who got short here and shorted to 280 and got about $30, $40, that's a good one. How to avoid falling into these traps? That's a great question, and I'm glad you asked. A great way to not fall for these traps is to wait for the retest. Always wait for a retest. As much as it stings, as much as it sucks to wait and sit on our hands, you want to wait for the retest. So if we're waiting for a break below this key level right here, instead of just shorting it as soon as we're below and having our stop say somewhere in the middle, that's not the best. What you're going to want to wait for is the push lower. We had a nice rejection. Bulls took over right here for a moment. We gapped up, we got into this zone to grab some liquidity, and then maybe because this was the pullback, you could get in on the pullback. And then once you get on this pullback, you're also able to adjust your stop accordingly, because now you have a new lower high to base off of as well. And that's also another big key, guys. there's three things I'd say you gotta learn in the stock market to make your trading a lot easier, and they come in twos. There's the supply and demand, which I went over in last week's webinar. There's support and resistance, which I'm going over today, and there's market structure when it comes to higher highs, lower lows, higher lows, and lower highs. That type of market structure will help you, along with key levels, to find where to place your stop, where to enter. So look, we're using this key level as an area where we want to come back, retest, and go lower, right? So that's how we're using the key level. But then we're going to use the higher low as our stop. So now we're using the higher low. And what we're doing is we're just using market structure. We're not using any indicators. We're not using any buy or sell signals. We're using market structure. We're using basic market structure and liquidity. We're looking for the liquidity grabs. We're waiting for the pullbacks and retests before our second move lower. And we're being patient in between. Patience is key. And again, guys, if you want to go into smaller time frames, you could always do that as well. Another good key level looks like about here. Looks like on top of this wick, because that's sort of sitting right there as well. Look at that. Very nice. Good holds. And then we held this. It wasn't to a T. Remember, guys, your key level will not always be perfect. You got to think of it as a key area. If you want to go over, grab the rectangle tool, and if that would help you to maybe make it about $1 width and do something like that, you could do that. Make it easier for you just to see, okay, this is the area of interest, this is the area of support or resistance. And that's a really great way. See again over here, consolidated, we broke it, we came back. All right, here's another good example of what I just showed on the smaller time frame though. So we had this tight range right here. I'm actually going to do this with, let's see, I'm going to do this on the horizontal. I'm going to show you we had this really tight range, right, on the 4 hour, which means we were just sort of ranging for about 4 or 5 days, not longer than that, about a week or so. So we were in this small range for about a week or so on Microsoft. We broke the range. Now, instead of being a breakout trader and taking the break of this range, you could have been patient, waited, knew we had this key level here. We broke the key level. We came back to grab more liquidity, because remember that everybody who's taking this breakout trade, they're going to end up selling their order again, not knowing that this is just the pullback before the real move. There will most likely be a pullback before a stronger move in the market if there's a stronger valid move coming, and you want to be in that move, not the breakout move. Breakout move is great for scalping. If you're into scalping, that's great. You know, we had consolidation over here when we broke out. I'm sure on the smaller time frame we had volume and volatility. Let's take a look. You know, right, so this was about 9, right, so this was the 9:30. We opened right here, and we just immediately just went up, came up, and we stayed in this range. What happened? We broke it. People who were chasing longs ended up getting stomped. They got stopped out. And what happened though? We ended up gapping up. So the people who were day trading, people who were not patient, did not get paid on this trade. If anything, they got stopped out on this trade. And then aggravated when the market opened the next day and was exactly where it should have been. So that's just another example of how you could trade a key level, how you could take support and resistance stuff. Most of the breakouts get retested. I would say so in my experience. I've seen a lot of breakouts get retested. It really does depend the zone, I suppose. Like if you wanted to mark a key level right here, right on top right there, you know, we came in for a moment to grab some liquidity before pushing higher. Let's see, another key level right here. So here's an example of us breaking this range, right? We broke this range, we pulled back, but instead of pulling back and continuing, we pulled back and failed to continue. So what this would have done was not only save you from getting in on the breakout, but now it's saving you from getting in on the breakout and then getting completely destroyed. I mean, this is a $10 drop in about a day on Microsoft. a day or two. Is this 2? Yeah, this is a 2 day drop on Microsoft. So the people who just got out of this break of range, this break of structure, they just got swept up. They got liquidity swept. We came back into it. We failed to go up again. So if you were waiting for the retest of the breakout and continue higher, you would wait for it to again break this level to go higher. We failed to do that. It would have kept you out of a losing trade. And if anything, you would have seen that we failed to break it. And if you were that eager to get in a trade, you could have placed a short position here with your stop loss above the highs over here. This is though sort of why I stick to futures only and don't really go to the equities, because we do have gaps pre-market. So if you did short it here because we were failing and put your stop here, who's to say that pre-market we wouldn't open up here? Whereas futures again are 23 hours a day. You could set a stop loss and it could go off at 1 in the morning while you're in bed. So I mean, or you could even set a target. You know, these are the types of things and privileges you get when you trade futures, and I think that's really great. But again, equities are great too. I would only suggest trading equities on the higher time frame for sure. You could always scalp them. Supply and demand does work on them as well. Do you use trend lines in conjunction with support and resistance levels? Yeah, so I use so I'm assuming trend lines, you don't mean like these diagonal trend lines, you mean like the, like, let's see, like a trend line. So yeah, I will use something like this in conjunction with key levels, right? So we have something like this. Yeah, exactly. So we got this, right? That was holding. This was a break of structure and key level. It retested it, broke it, did come down lower, but then it failed. We got a gap up. This could have been, yeah, this was an earnings play, so I wouldn't have traded earnings, especially if I'm going down. Well, I wouldn't have traded earnings regardless. That's a tough one, especially because we were in a more bullish market altogether. So let's see. Let's get into another chart real quick. Let's just check the Nasdaq, see if there's anything good over there. And again, guys, so anything you see me doing on the higher time frames, you can do on the smaller time frames. Just don't expect the levels to be as strong and accurate. So we can mark this high right here. We can mark this low right here. Here's our range, right? That's our range. Then we tried to break it. We started to consolidate right near the edge. What we're doing here is we're accumulating. What that's doing is that's grabbing liquidity from the market. The people who are shorting the top of this range are shorting right before we get a big push up. And what happens, they just are, again, liquidity swept. We break it. And if you were that unsure to take it, right, you wanted to wait for the retest because you're more of a waiter, then you wait for the retest. We got the retest right here. You go long and you take it. Obviously, this push higher did not go higher than this one, so that would sort of leave you in a tough range and a tough spot with your trade. Can you define what you consider higher and lower time frames? So wicks and smaller time frame. Alright, so first, can I define a higher and lower time frame? So think of lower time frame as anything an intraday day trader would use. 5-minute, 15-minute, even a 30-minute is considered a bit of a smaller time frame. I would not do key levels on a 30-minute time frame, 45-minute time frame. Really, I'd really just consider 2-hour and higher. This is the 1 hour on Nasdaq right here. You could, of course, do the 1 hour for ranges. What's really great with support and resistance, guys, is as great as they are on the higher time frames, they are great on the lower time frames. And again, when I say the lower time frames, 1 hour, maybe 30-minute. And the reason for that is it will give you a range. Support and resistance gives us the range. Yeah, for sure. So wicks on smaller time frames and bodies on higher time frames, right? Yes and no. Yes and no, sort of. So, like if we're looking at the daily on Nasdaq, right? And I wanted this key level, this I would do this one right here, and obviously we didn't touch it each time. We just touched it this one main area, but it was a very strong area of interest. So again, this would be what I call an AOI. When you guys see me post my charts in the morning, you'll see me call some things supply zones, demand zones, key levels. I'll do KLS, key levels. And sometimes you'll see me do AOI. That's an area of interest. These are things that I use as supply, as demand. These are levels where there's a lot of liquidity and tends to be some type of rejection or reaction in the market. So again, let's say I wanted to do some sort of AOI right here. Do it like that. And it did end up working a few times. And let's see. So yeah, again, bodies or wicks. It's really when you're finding these key levels, you're not finding an exact number. You're finding just a strong key psychological level too. So let's say there was a key psychological level, like a key whole. When I say psychological level, guys, I'm talking about a whole number. So here we go. This one put at 15,260, so 15,260. That's a whole number. So this could be a key psychological level. So if you're able to find these whole numbers near your key levels, those are also very strong. I know we were down near, I believe it was 13,800. Let's see, 13,900. I mean, the 1400, I believe, was a strong area of interest as well. If we look back, this was where is 13,400? Again, guys, these are just all whole psychological levels. Or the retail traders, especially the inexperienced ones, the ones most impacted by these liquidity grabs, because institutions would not be reacting to them. Yeah, so again, you really got to think of these liquidity grabs as the market knows what we're watching, and the market knows how we read charts. So the market knows that there are more than enough breakout traders in the world that it could just grab liquidity all it wants. Whether it wants to break out on the 5-minute chart for about 3 or 4 candles and then come back and grab about 20 minutes of liquidity per se, or it wants to break out like we saw right over here on NASDAQ. It broke out of this key level for hours before coming back and grabbing more liquidity. So the question remains on this trade, which we could follow up on Monday or when we open tomorrow evening for futures, is because we created a lower high off of this high, are we going to be coming back into this zone, or are we going to hold it like we did right here? So this, I would look for maybe a demand zone. So let's see if we have a demand zone here. Again, I do know we're not doing the supply and demand webinar, but having your supply and demand zones along with support and resistance levels is really ideal, because then you're able to use both of them together. You're able to say, okay, well, I don't have any key levels over here, but I have a demand zone. I'll get long in demand and I'll target the key level over here. So it looks like we have a bit of a 2-hour here. It's just a little funky, not the biggest fan of that. See if we have a 90-minute. Let's see. Yeah, so I guess I would prefer this 90-minute zone right here. And we'll do 90-minute. I'm not going to mark out the time because this isn't really going to be a bit of a demand or supply or demand webinar. I'm just going to be going over this just to show you. So you could sort of see how we created a demand right near the key level. Now, a lot of times you'll see a supply or demand be created near a key level, and what that's going to do is that's going to give you that extra confirmation of, hey, listen, institutions are watching this level. A lot of people are looking at this level. Watch for not a breakout, but a retest, because these are areas where the market is high probability to reverse. So now you see we broke this key level, and you take a breakout, that's great. If you wanted, you could scalp it all the way up, as long as you have a really close trail stop, scalp it all the way up. And then we came back, and what happened when we came here? People are selling, people see how bearish this is, and then we get this candle close. And this is something I mentioned on Friday that's super important, guys. When we see a candle close and it doesn't have much of a wick towards the direction it's going, a lot of times retail will read this as strength, whereas institution could see this as some type of fake out or some type of trap. What I look for on these types of candles is the following candle to close in the opposite direction before continuing to the move lower or the move higher, depending on where we're going. This would be a good example of a drop, a base, but I would have wanted a drop right after this base candle, which we did not get, which shows me buyers may be present, although we created a lower high based off of this high, but we're still breaking out of this range, reclaim this range. So what I'm personally going to be looking for on Monday is I'm going to be looking for this key level or this demand zone to be holding on NASDAQ before I go long. And again, you could be doing this with ES, you could do this with NASDAQ, you could do this with gold, you could do this with silver, anything with high volume, high volatility, mainly the high volume. You could do this on the dollar, you could do this on Forex. High volume creates supply and demand, and if there's supply and demand, there's most likely support and resistance. Support and resistance is where the institutions are watching and placing their orders. Have you ever tried fluid trades? Some see light indicators, support and resistance, volume change. No, I don't really, Joe, I don't really do any indicators. I'm just reading the chart. Yeah, no problem. I'm happy to do this. I hope you're all enjoying. I hope you're all learning something. But yeah, Joe, what I do is I just read the chart naked. And by naked, I mean just the candlesticks, and I'll plot my key levels, I'll plot my support, plot my resistance, and find my supply and demand. And that's how I find my areas where I'll want to go long or areas where I'll want to short the market. So like, let's say you did want to short up here because you saw we were starting to sell off, you would look on the 15-minute for some type of confirmation. Now you could have either entered once we had this closing candle because this was a rejection, or you could have waited again for some type of pullback to prove a lower high. And again, here's another great example of us getting a candle that closes with no wick in the direction it's going, and then it reverses right after. And again, look at this one too. Little to no wick where we're going, reversed right after. Same thing again, right after. That's a very key thing to look for, because when people think, oh, well, there's no wick, there's a little wick, not much of a wick, that's strength, or that's weakness, or that's strength. But sometimes in all reality, that's a trap, because we think it's strength, the market knows we think it's strength, so they're trapping us. Just putting the dog down on the bed, just itching to get down. Alright, so let's take a look real quick. We did some NASDAQ, we did some ES. Another thing you could do, let's see. Let's head back into ES real quick. ES is the futures I usually tend to watch. Guys, I do appreciate you all for joining in and tuning in. We do this webinar. I'm going to be doing this webinar every Saturday at 6 p.m. It's going to be either supply demand, support and resistance. Maybe next week I'll get more into divergence. I did get a lot of good feedback on the supply and demand one, so there's a good chance I'll be doing another supply and demand webinar if you guys are interested. But yeah, sure, no problem, for sure. Don't forget to hit that like button. I do appreciate it. And let's get back into this webinar. So if we take a look over here we would have had another intraday key level, right? So you guys were asking about which time frames to watch, what to use. And again, once you do start using the smaller time frames and stuff, you will be getting a lot more key levels on your chart, and unless you're color coordinating it and you know what color means what time frame, it could get a little difficult to understand, oh, okay, this is a smaller time frame, this one won't be too strong, or oh, this is a higher time frame, I should definitely watch out for this one. But this was an example. Look, this was our range, we broke down, we came back in, and then we sort of held it, came back in, held it, came back, retested it, liquidity grab, and went higher. But again, too many zones, too many levels, it gets too messy. And once the chart gets too messy, then you start getting too overwhelmed, and you can't trade when you're overwhelmed. Then you start making impulse moves, and when you make impulse moves, the market does not make impulse moves. We'll put it at that. The market moves how the market wants to move. Alright, so let's take another look. Let's take a look at, do you guys have any chart recommendations you want me to do some support and resistance on? This is something that does work on most charts as long as there's high liquidity in it. Will you post it? Yeah, Lanny, welcome to the webinar. Appreciate you joining. The webinars are going to be posted on our YouTube in the live section, and they're also going to be under, there's going to be a playlist titled webinars. It's going to be under that as well. Somebody said RCL. Royal Caribbean. Okay. Okay, that's all right. Let's take a look. Gold futures. All right, we could do gold futures too after. So let's see. So here's a strong key level, right? So let's see. We're starting at the 1 hour again, guys. 1 hour is okay. 2 hours okay. Would not go lower. Um, let's see. Do another one right here. And again, look, once we're resisting this level, we're resisting resistance. And then what happens? Now we're supporting. It's support, it's support. We break into it. This breakout was a fake out. We end up coming back in. It's a liquidity grab just for the move higher. Let's see. Let's go to the daily real quick and see if we can get some good daily zones. And looks like we got some other. Yeah, I'm gonna do gold futures in just a moment. Let's throw one up like right here. That's a good key level. So you see why I say that's a key level is because we had 1, 2, 3 rejections up here. And it also worked over here as support and over here as support. And again, it's not going to work to a T every time, but it will work near that area. If you want to mark it as an area of interest, that's okay. HCP. Okay, so let's do gold real quick. And I'm just going to be doing just a few basics just to give you guys examples of how I do find these zones, you know, higher levels, higher time frames. The higher the time frame, the stronger the level, just like supply and demand. And once you're able to find these strong key levels where there's strong areas of rejection, you're really able to throw that in with supply and demand and really have almost pinpoint accurate entries, exits, and trade plans. And that's really a big thing too, is once you have your levels and your zones plotted out, in the morning, sometimes you don't even have to chart. Sometimes you just have to create your trade plan based on your charts. Sometimes you won't get a demand zone broken or a supply zone broken for a while. So you just keep sticking with the plan or you wait till the plan works out. So let's do a key level right there on gold. I'd probably do a key level about over here. I'd maybe want to do it a little higher because of those rejections over here and here. So this would be a good key level as well. Again, a key level does not have to go perfect. If you want, look for some type of break. It was a liquidity grab. We came back higher. Then we came back and retested this key level. So that's something to keep an eye for too, is a break, liquidity grab, move higher, and a retest of that level. Just like a demand or supply zone if you want to wait for it to break out of it. Retest and go higher, because what we're getting on that retest as well, guys, is we're getting that higher low, and that's again a bullish market move. That's tells you we're in a bullish market. We're getting a higher low and it created a higher high. We didn't break this low until we did. We broke this low right here, but if we zoomed out, we're on the higher time frame on the daily, we would notice we didn't break this low. And so anybody who was in long at all over here waiting and had their stop at previous lows because they knew where they should put their stop, they held through this pullback and were deeply rewarded because they got this big push up. And a lot of times people are saying, oh, I'm never in the move up, I'm never in the big move. Well, sometimes that's on you, sometimes that's on us and on our entries. So let's see. What time is it? Alright, I am going to be wrapping this up shortly, probably about like 10-15 minutes. So again, I would mark this area, and when I'm doing key levels on TradingView, I like to use the horizontal line versus the horizontal ray, because the horizontal ray just goes to the right, whereas the horizontal line will go to the left as well. And with that, you're able to really see the history of that level. Let's plot another key level right here. Because as you see, we held it. Again, we do break below. But once we break below, what happens? We hold at the next key level. Right? Look at this one. This is a really good one. 1, 2, 3, 4, 5, 6, 7. Then we break its resistance, That's a really strong level. When you create a zone around the support and resistance levels, would it be better to create based on the ATR? So when you're creating these supply and demand or support and resistance zones and levels, especially the support and resistance, Oh, I think I get what you're saying. So, like, make the area of interest as wide as the ATR would be. That's an idea, and if you want, you could always try that. What's great about the market is it's all experience. I could teach as much as I want and teach you guys exactly how I trade, but as individuals, we all trade differently, we all do things differently, we all learn differently, and create our own trading style differently. But what you're going to do when you're learning is you're going to take pieces of what works for these other people. You're going to find what works for these other people, and you're going to add it to your own trading style. So if I'm giving you good areas and good input on key levels, and you happen to find another great trading style that has RSI divergence, then fantastic. There's RSI divergence, there's MACD divergence, there's all types of divergence. Again, I personally do divergence between ES and NQ. That gives me shift in market sentiment. Somebody asked what's ATR. ATR is average true range. That's gonna be like if you're looking at the daily ATR. It doesn't have it up here, but like let's say the average true range of ES is is 10 points. So then you would make the zone maybe 10 points wide, or if you wanted 20 points wide, right? 10 points on each side. That's the ATR. Let's say Microsoft on average moves about $3 a day. Its ATR is going to be $3. Could it be $5 one day? Absolutely. Could it be $1.50 one day? For sure. It's just the average. Let's see. So this was gold. I think, was there any other recommendations? HCP. And if you guys got any questions, if you want to pop them right in the chat, I'll take some questions now before I wrap it up. This will be a bit of a shorter webinar tonight, just because there's not much in depth we could do on support and resistance like we can supply and demand, where we could get like zones that intertwine. But again, guys, knowing your key levels, knowing your support and resistance is really, really important, because then you're able to use key market clues. You could say, okay, let's look for a higher high. I just want to see real quick. I want to look for an example of something. Right, so, right. So if we were looking at the 15-minute, and we were looking for market clues, and we were seeing this key level, we rejected it perfectly. We could have entered long off of it and put our stop right at the key level, and that's how great that key level would have been, because we did reject it perfectly, right? So we trust our zones, we trust our levels, we get in, we target, say we want to target just a 10-point move, 20-point move, it all depends. Like Solido Gloria mentioned, ATR is a big factor too. If you're targeting 50 points on ES, but its ATR is 20 points, you might want to lower your target, right? But that's also where supply and demand comes in, because if we don't have a supply or demand zone for a while, and we are getting volume and volatility, that could give us the hint that, hey, you know what? We might have one of those big moves today. And what's great about that is when we get the alert of, hey, we're having a big move, and we know support, resistance, supply, demand, we have the upper hand of getting in and being in on that bigger move. You know what I'm saying? And that's really great. Whereas a lot of retail traders are, oh, I'm never in the big move. How come I never am? Never me, never me. It's not because the market doesn't like you. It's because you haven't learned how to find those zones or levels yet. And once you do find these zones and levels, and you're able to read market context, and you're able to read market structure, like this is the 15-minute now, right? And I said I don't like to mark the key level on the 15 if I wanted to, right? And we were looking at the trend, and we were looking at the ranges. I would maybe just make this like a blue one, but we were in this range for a little bit. We broke it. We came back. We had 3 wicks inside it, and we bounced again. Now, since we are in a bear market, you slightly increase your stop loss a few marks. Joe, I wouldn't really consider this much of a bear market, just because we've been making year-to-date highs on ES, NASDAQ. I think the Dow is also green year-to-date. So when I say year-to-date, I mean January 1st to now. So year-to-date on ES, we are... Right, so we opened somewhere over here, and now we're all the way over here. So year-to-date, we're sort of in a bull market, as much as the media wants to present to us some type of bear market. What we could get here is we had some type of big move up. We could get a liquidity grab, right? And we could sweep right back into this range, right? So maybe we'll get a move lower. And if you guys want to tune in Monday, I'm going to be live and I'm going to see if this move plays out. I do think we do come lower into this area to grab some liquidity from here, but we'll have to see. Let's see. And again, you could add supply and demand to these zones, and that also works out. And with supply and demand and key levels, you could really make some great trades, some great high quality trades is what I'm aiming for. I want high quality trades where I'm getting in because I don't only have the support of a demand zone, but I have the support of a key level as well. And that's really, really strong. That's really some type of trade I would want. Another thing that I like to take to consider is to look at the higher time frames for some type of trade setup. So if I was watching this on Friday, if you guys watch Friday's video, I mentioned right before, I'd say around 10:30, so about a half hour before the video ended, I went to the hourly and I said, okay, it looks like we're getting a big hourly wick up here. And because we've been breaking supplies on ES, that is bullish, but that also means we're going to have to start creating new supplies. So I said, if this candle right here closes a small body, small green body, and a long upper wick, I expect some type of bearish move after a big impulse move lower. Now, I was expecting more of a sell-off, an all-day sell-off, where these candles would also be red, sort of to bring us back to this area of interest, but we didn't. But we did still call out this top, this area where we could have shorted. And once we short in this area, what we could do here is we could have our entry, we could have our stop, and we could target about right here. And what you do is you can move your stop as we go, right? And you could still technically still be in this trade if you wanted to go lower with your target. But I would have realistically used this key level as a target. And although this isn't the highest quality trade with risk reward, because it's only about a 1.701, this is still a high quality trade because you're getting on the higher time frame, and you're getting on a big rejection off the higher time frame. So what you would have also been able to look for is a lower time frame, maybe higher high, higher low. If we look at the 15, we get the perfect rejection, move lower, and a higher low right here. We could have even shorted if we were looking at the lower time frame and we wanted to get in assuming the hourly would close like that. We could have really got in near some type of top over here. I don't want to say we got in at I don't want to say we get in at the top because that's unrealistic, but let's say we got in about here. Now we're really making a difference on the type of risk reward trade we're taking. And that could really make or break a good trader. You know, you have a 3-to-1 risk reward, 4-to-1 risk reward. If you're averaging these 3-to-1s, 4-to-1s, you're able to win 30% of your trades, 40% of your trades, and still be profitable, still be a successful trader. And that's really, really a great thing to keep in mind when you're trading, because a lot of times people want to go for home runs, but base hits are the way to go. But if you're able to manage your risk reward, manage your size, and get in high quality trades based off price action and support and resistance and supply and demand, if there is a supply and demand zone, then you're really able to add these clues, add these puzzle pieces together, and find high quality trades and really execute them and really profit and really do well in the market with this type of market action and market structure and with these tools. Thanks so much for that. What is time frame futures trading week hold? What is your time frame on futures trading week holds or every couple of days? I have not tried futures but want to learn. So Joe, I day trade futures, but I will mark my zones just like I'm showing you guys today. I always go for the higher time frame, and I always try to so yeah, you see if we went on the 15-minute, we would have gotten on this 1 hour right at that higher low. That would have been a really, really nice entry. And that would have been almost a 4-to-1 risk reward. That's good. That's great. Alright, so Yeah, so I do day trade equities, not equities, futures. So I'll usually be trading off the 5 and the 15. So I'll look for just context clues. I'll look for, higher lows. This is a higher low right here compared to this low. This is a higher high right here compared to this high. This is again a higher low, higher high. Then we reject. Then we start shifting in market. So we created a lower high right here. I do want to see if NASDAQ created that lower high as well. Yeah, NASDAQ also created a lower high. A lot of times I personally look for some type of divergence to get into a trade. This wouldn't have been divergence. This would have just been it following trend. But that's about it on that. Is it? Yeah, 5 minutes. All right. If you guys, I am going to wrap this up. If you guys got any last minute questions, I do appreciate you all for tuning in. If you don't mind, again, hitting that like button, it does go a long way, even though it's just a little like. And again, you guys can tune in every weekday. We are live trading. We are in the YouTube live. It's free, completely free to you guys. We have a Discord you guys could join. We offer one-on-one sessions. We offer a whole lot of stuff. It's a really great community full of traders, like-minded traders who just want to help each other succeed. One more, is there a day that has better volume on futures? Nah, I wouldn't say there's a specific day. I would but volume's very important. Do you include the Dow for divergence? I do. I used to not really use the Dow for divergence, but some people pointed it out. I'm gonna shout out to Amy. I don't know if she's watching, but she's part of our Discord, and she pointed out to use the Dow, and that sort of has been helping as well. Because sometimes what you'll see is Nasdaq creating a higher high, ES is creating an equal high, and the Dow is creating a lower high. So that Dow creating a lower high is almost what's bringing ES down to have divergence with Nasdaq. So is it necessary? I don't know. Does it help? Absolutely. Thank you. Yes, absolutely. Guys, it's been a pleasure. It's always fun hosting one of these webinars. This is my second one. Always a little nervous getting into it, but it's always a pleasure talking with all of you. I do hope you guys learned something. If you did, again, hit that like button. Appreciate you all for joining. I'm going to be doing this again next Saturday. Definitely tune in. We'll see what kind of topic. If you guys want to leave a comment on what type of topic you guys would want me to go over, we could do that too. And we do have other traders in our group, other members. There's Bullishbrs Jeremy. He's a very smart when it comes to option spreads, credit spreads, debit spreads, things like that. Whereas I'm more of I trade futures, I day trade futures, and I day trade supply and demand along with key levels. And in the Discord, you could always request charts whenever. And if you guys even hop in the YouTube and you see that we're streaming, request a chart, we'll pull it up and we'll show it to you. It's no problem. We're here to help you guys. We're that type of community. We're a give back community. We want to see you guys do better. That's how we know we did our job. All right. With that being said, I am logging out. Happy trading, everyone, and thank you again for joining. Have a great day. Take care, and have a good weekend. Happy trading. See you guys all Monday.